Good evening and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now today I want to talk a bit about inflation. So if any of you have watched my very first video, I talked a little bit about what inflation is and why it's important when thinking about investing. But tonight I want to go a bit deeper into inflation and really talk about what it is, what causes it, is it good, is it bad, and how we can take steps to make sure it doesn't affect our financial future. So let's just get straight into it. So, what is inflation? Inflation is basically the very, very slow and steady increase of prices. Or if you want to think about it a different way, it is the very slow and steady decrease in the value of currency. So every single economy in the world experiences inflation. Now this can range from a very small amount to a very large amount, and it can even sometimes be a negative number. That's called deflation. I know Japan's had a lot of problems with deflation, but most countries experience inflation on a pretty permanent level. So for example, the inflation level in Australia at the moment is between 2 and 3%. That means that the Australian dollar is losing between 2 and 3% of its value every single year. Now that might not sound like a lot, but in reality it means if you hold a $100 note and you wait a whole year, that $100 note will buy you $2 less of something than it did 1 year ago. And this will happen again the next year. It might be a different rate, it might be 3%, it might be 1%, but that $100 will lose another 1 to 3% of its value the following year. And so you can see after a while that $100 is going to start losing a significant chunk of its value compared to when you started. So that's basically what inflation is all about. Now most of us are aware of inflation in quite a passive way. So for example, if you look at an old grocery list, you might see a loaf of bread for 20 cents or a bottle of milk for 50 cents. And most people go, oh yeah, that's just how it was back in the day. But that is evidence of the slow but creeping effect of inflation. And this effect doesn't stop. It's always there. It's always working in the background, slowly devaluing the currency, slowly increasing prices over time. Many people remember the McDonald's 30-cent cones. Well, they're not 30 cents anymore. That is inflation at work. And there probably won't be 30 cents again. Very, very slowly they'll go from 50 cents to 55 cents to 60 cents. And you can see this across the whole economy. Every single thing that you buy will usually have this effect if you look at its price over time. Now it's very, very slow, but it does not stop. So now I want to talk about why inflation is important. Because there are good things and there are bad things with inflation. So for example, a good thing would be most years everyone gets a pay rise. You might get a letter from your employer saying, congratulations, we've increased your wages by 2% or 3%. So if it's above inflation, that's an extra bonus because that means you're actually getting what we call a real wage rise. But most wages will rise at least to cover inflation. And your employer might dress this up and saying, oh, we're doing you a huge favor, but really wages will usually always cover inflation. And employers can use this to their advantage. For example, if the rate of inflation is 2%, and they don't want to really give everyone a real pay rise, they can increase everyone's wages by 2%, and it actually doesn't cost them anything because the real wage rise is actually zero. Because as they're raising their wages by 2%, you can bet that they're also raising whatever they're selling, however they're making money, they're raising it by 2% as well, because that's what inflation is. It's across the board price rises. So inflation is also good if you have debt. If you have a home loan, you might borrow $200,000. That $200,000 doesn't rise with inflation. So in 10 years' time, that $200,000 will have gone down in value in real terms. Inflation is a good thing if you're in debt because your debt will slowly be declining in real value. This may, of course, be offset by an interest rate. So if you've got a credit card loan with a 20% interest rate and the inflation rate is 2%, you're still paying in real terms, 18% on that interest because you're deducting the inflation rate from the interest rate. So it doesn't always mean it's a good thing if you're in debt and there's inflation, but it can make a difference if you have a mortgage or a lower interest loan at say maybe 5% because that inflation rate of 2% will shave 2% off the interest rate. So you're actually paying a real interest rate of only 3%. So inflation can be good if you're a borrower. Of course, this works in reverse when we're talking about saving. If you're putting money into the bank, that money is slowly losing 2% a year from inflation. Now, banks will normally try and compensate you for this by giving you an interest rate that normally is around the inflation rate, say a 2% interest rate. But that means really that your money's only keeping its value slowly. It's not losing money, it's not gaining money. So if you see a bank that's offering an interest rate on a savings account, really keep inflation in mind, because that's what you're actually trying to beat. That's your enemy when it comes to your long-term wealth, is inflation. So in order for any savings account to have a real impact on your financial future, it has to have an interest rate that outstrips inflation. Okay, to explain this a bit more, I've basically got here what a typical person does with their income. So money comes in. This is income. I have your income. So the green arrows are money coming in. You know, you work your job, you might have a rental property, hopefully, and it's giving you some income. So that comes into your bank account and your paycheck or whatever. And a lot of people, the money just goes straight to the expenses. Everyone's got bills to pay, groceries to buy, petrol to fill up with their car. The list goes on. And maybe you think, okay, I'm going to start putting some money away for a rainy day. So you open a savings account. So all of a sudden, some of your money is starting to go in the savings account. And that's great. Maybe you want to increase it over time. Fantastic. But the savings account is also an expense, because as that money is sitting there, it is slowly losing value because of inflation. And if you're lucky enough to get an interest rate that's above inflation, it's really only keeping its value. You're not going to get rich from having a savings account. For example, if you have a $100,000 in a savings account, you'll be getting $2,000 interest per year. That's per year. But also that $100,000 will be able to buy $2,000 less of stuff every single year. Okay? So what I've done here is, this is what everyone should be thinking about. Directing some of the money into an investment or investments. Because once you start putting money in, this is how you beat inflation. Because most investments, if it's a good investment, you can get above the rate of inflation return. For example, an index fund in a stock market will typically return between 6 and 10% per year over the long run. So that's 6 and 10% per year, that's actually growing your wealth, growing it in real terms. Because even when you factor in inflation, you're still getting between 4 and 8% return. And this money can compound over time. It can make its own money. And that also beats inflation even more. So that's why it's really important to have this system in place and not just have this in-out formula that a lot of people struggle with. So that's how you build your financial future. That's how you build financial security, is by beating inflation, not just by opening a savings account, but by actually finding assets that will give you a real return, an inflation-beating return, and hopefully you can compound that over time to make you even more money. That's money working to making you more money. Now, how good's that? So you put your money away, and it will slowly make its own money over time. That's what investing is all about, and that's how you beat inflation. So I'm not saying that no one should have a savings account. That's really, really important, but it should be a very small part of your long-term financial plan, because once you get this going, it fills itself. It makes its own money. You can even, say if you contribute to this for 10 years and then you stop, you might have a home loan, you might get some kids, you might have to change jobs because you're not happy with the job you're getting, even though you're on a really high salary, and you stop contributing to your investment fund. If you've been doing it consistently for 10 years, that investment fund will be making its own money. You don't even have to put money in. It's money working to make you more money. And that's what investing is all about. Getting real returns, not just on paper, but inflation beating real returns. So how does this happen? How does inflation happen? Basically, the government lets it happen. That's the long and the short of it. The government lets it happen because it makes the economy run a little bit better if there's a little bit of inflation. It means that employers don't have to give an actual pay cut if they can't afford it. They just hold back on the pay rise. If inflation was at 0%, businesses would actually have to cut your pay in real terms in order to give you a pay cut. But under the inflation system, they can just stop giving you pay rises, and that is in effect the same thing. And that works for government benefits as well. The government loves it because if they want to give a welfare cut or a pension cut or a spending cut of any kind, they can just freeze it, just not increase it. And that's the same as giving it a cut, because over time it will become less valuable, and the amount of money in real terms the government will have to shell out is less. So the government actually is quite fond of inflation. So before 1973, all currencies in the world were tied to the US dollar. In many ways they still are. But the US dollar in turn was tied to the price of gold the metal. So what this meant was inflation was actually very, very, very low, if almost non-existent, because there is only a finite amount of gold in the world. That's why they pick gold, because it's valuable. And there's actually a very, very small amount of it. And the amount of it does not increase very much every single year. So US dollars were tied to an ounce of gold. 35 US dollars would buy 1 ounce of gold. And that's how they kept it for many, many, many years. This system was implemented after the First World War, and it was dismantled in 1973. So for a very, very long time, US dollars was tied to the price of gold. And this actually made inflation not a big issue. But it also meant that governments couldn't spend as much money as they wanted, like they can today, basically. So why the US took themselves off a gold standard was because of the Vietnam War. The US was spending way, way more money on the Vietnam War than they actually had in gold reserves. So, for example, if every single taxpayer in America took their dollars to the bank, to the central bank in America, and said, we want our gold that this dollar is worth, the US government didn't have enough gold to pay them all. So President Richard Nixon decided to take America off the gold standard. Now, in 1973, $35 would buy you 1 ounce of gold. Today, it is over $1,200 will buy you the same amount of gold. Now, the supply of gold hasn't changed. That's happened because of inflation. So when the US government took themselves off the gold standard, it basically meant that their dollar wasn't really tied to anything of real value. It's basically how much the US government decides it's worth. So that means that if the US government wants to spend more money on a war, they don't have to get more gold, they just print more. That means in a recession, if the government runs out of money because people stop paying taxes because they're either going broke or they lose their job, which often happens, the government can print more money. They don't have to go and buy more gold. So that's basically why governments like inflation. It means it gives them greater control over money because the supply of money is not fixed. So to sum it all up, guys, inflation is something to really keep in mind while investing because it is a financial enemy. There is no doubt about it. Every dollar you earn today is going to be worth less tomorrow. And that is something that everyone needs to keep in mind when planning for their financial future. So have a look at this graph, maybe see, what stage you're at with it. Maybe consider opening avenues into investment, or if you already have, making some more or putting some more money into it, because really inflation is our enemy and we all have to keep it in mind when planning for our financial future. Alright guys, thanks so much for watching. Hope you enjoyed this video. I'll be back with some more videos soon, but for now, good night.